Hello, I'm Michael Schildberger. In recent years, we've all seen a gradual erosion of time-honoured methods of business and tax planning. Many of these arrangements exploited loopholes in the taxation law, and those loopholes, quite rightly, have gradually been closed. Thus, we've seen not only the end of the tax scheme era, ending in a tax on the bottom of the harbour scheme, but we've also seen the demise of the internal loan-backed superannuation fund. Many advisors have virtually thrown up their hands in horror at government moves against these practices and have resigned themselves to advising their clients to pay vast amounts of tax and to grin and bear it. This program is to show you that there is an alternative. The Fothergill Financial Incentive Plan, which we'll call FIP for short, is a logical alternative. FIP is a totally integrated financial package. As you'll see later, it's made up of 6 different elements, all working together in coordination. Not only do the elements work together in coordination, but most important of all, unlike the old schemes, the various elements have either been approved by the Australian Taxation Office or are standard business practices. A central core of the plan is superannuation, properly invested at arm's length. All the calculations used are certified by actuaries to comply with tax office guidelines. Australia's ageing population, we've gone from an average 27 in 1971 to 30 in 1983, makes continuing government support of superannuation vital. Superannuation is probably one of the best methods of relieving the enormous strain on our economy of an increasing number of social security benefit recipients. The alternative is for more and more of our population to be dependent on government social security pensions. And such pensions are barely supportable today and are at subsistence levels. Imagine the emerging problem of having to supply many more people with pensions, but with less people to actually pay taxes to provide for them. Why point this out? Simply to emphasise that the Fothergill Financial Incentive Plan has been designed with this problem well in mind. It's been designed as a long-term plan, but with short-term benefits as well. It fits in with government thinking rather than trying to go against the trend, as was the case with the old schemes. Michael Spencer is Managing Director of Fothergill Proprietary Limited. You have an example of FIP in action.
Yes, Michael, we've got here a medical specialist. Let's call him Dr. Fred Frogmorton. He's actually aged 45 and he's been in practice for some time by himself, and he's been thinking about incorporating his practice, but nobody's really ever been able to work out the numbers for him so he could make a decision. Now, currently he has a net income after expenses of $125,000, of which some $110,000 is derived from his practice. He's able to pay $1,200 per year into a self-employed superannuation fund and to receive a tax deduction for it. He's also very interested in various private investment ventures, and currently he's thinking of going into his new one, which is a witchetty grub farm, and he's going to invest $12,500 into that, and he hopes to get a tax deduction for that particular expenditure. He continues along this financial path, and if he did that, he'd pay some $52,500 in income tax per year. And by the time he retired, if he kept that up, he'd be worth something like $1,068,000 after tax. This all assumes that he pays a lot of his other after-tax income into further private investment as well, leaving him a common base to live on. And we're assuming that common base for the whole of the comparison that we're going to show you. Now, on the other hand, by using FIP, he's able to have tax-deductible superannuation investment contributions made of some $24,000, and that's made by his company on his behalf. And this is based on a salary of $60,254, which we've calculated using our optimizer technique. Of course, he can still continue to contribute to his witchetty grub farm venture just the same. I should point out at this stage that the figures that you're seeing now won't add up, because there are in fact a number of other factors that make up the balancing items, such as we've taken into account cost of workers' compensation insurance and payroll tax and a number of other factors. Now, by following this plan, which includes the capital leverage system, Dr. Frogmorton's income tax payment reduced to $26,300 per year, and his assets will accumulate to some $2.6 million by retirement age, and this is all making exactly the same assumptions as previously. Now, of course, there's one real disadvantage, if you can call it that. He actually suffers a cash strain of some $8,000. In other words, he's down this year some 8,000. If he kept on doing this, he'd keep on being down some 8,000, and that's the reason why a lot of people are very much discouraged from putting a lot of money away into superannuation. However, because we have the capital leverage system involved in the FIP, this cash strain will gradually reduce over time. Now, the capital leverage system can be likened to a sausage machine, if you like. Capital's fed into it, and various herbs and spices in the form of tax and cost efficiencies are added. The result is that the sausage machine produces a flavoursome sausage in the form of more capital available for either investment or working capital needs. In short, the capital leverage system becomes more efficient over time, so that will gradually alleviate or even eliminate cash strain entirely. But this still leaves the short-term cash strain problem. And the solution is to introduce supplementary finance from an external source to eliminate the cash strain, or at least to reduce the impact on the hip pocket nerve and bring it down to a comfortable level of pain. So let's have a look at this diagram to see what this means for Dr. Throgmorton. Now, here you see a diagram which shows his relative growth in assets on his unincorporated position, which is the bottom lot, and on the top line leading up to 2.6 million. So you can see that all the way ahead, even allowing for finance, he's well ahead, so that if he wants to stop, he can stop. There's one important point which needs to be made at this stage, and that is that we've just shown you one example which is just typical. Now, we're using large numbers here, but you could drop those numbers down to quite small numbers and the relativity is still the same. So what you see here are the combined effects of a truly integrated and coordinated financial planning package, and we've used the various elements of FIP to produce this quite startling result. That is, in this case, an improvement of some 248% in Dr. Fred's original position after tax. It's probably of some interest to point out that Dr. Throgmorton also carries some $675,000 of term life insurance. Now, under the FIP, cover has been increased to $1.5 million. However, you should note that only the cost of the original $675,000 has been taken into account in our projections. The extra cover is supported entirely by the plan.
Fothergill Proprietary Limited's actuarial advisor for some time has been David Orford, Managing Director of Financial Synergy Proprietary Limited. He has given advice on product development and has been responsible for computer programming. David Orford, some amazing figures. How can we believe them?
Oh, Michael, I think they're quite believable. In fact, they're calculated on a very conservative basis. But I think you must appreciate they use a number of tax efficiencies and margins in the whole thing. So they're, when you consider this a very low capital investment in the thing, it's quite believable.
Now, I believe that the plan uses a redesigned life insurance policy. Could you outline the essential differences between this and a conventional policy?
Yes, well, that's one of the number of efficiencies that are involved. As you know, about 3 elements in every life policy: the expense charges, which in this case are very low, the life cover charges, which also are very low, and the investment component, which in this case, because the other 2 components are very low, is very high. And you've got to consider the investment component is invested in a special pool that gets an exceedingly high rate of return.
One of the features of the plan is the optimizer. What's that?
Yes, the optimizer is a very important part of the plan. It involves, for a certain level of remuneration, a method of calculation to derive the optimum mix of packaging for an executive or a key individual. So it derives a certain salary at which tax is minimum. And if you pay yourself a greater salary or less salary than that, you'll find that you will in fact pay more tax. So it gets the optimum remuneration to the nearer dollar.
Now, one of the strategies of FIP is to use pension calculations. Why?
Yes, I think the major reason is that they're supported by the Australian government. The Australian government wants people to be in pension plans because they help reduce social security outlays, etc. I guess the alternative is to have a lump sum plan, but there I think the government is going against lump sum plans because they're scaling down the maximum benefits in real terms. Also, I think the tax situation, now we've got a lump sum tax, superannuation is still a very good investment relative to the alternatives, and by going through a pension route you're maximising your gain because with pension you get a far higher tax deduction. And finally, I think you must appreciate the tax office did increase the limits for pensions back in 1982, and nobody asked them to do that, but they did it of their own free will. So I think that they want us to be in pension funds, and from a personal point of view, it's the most tax efficient way to go.
Michael Spencer, what does the Australian Taxation Office think of it?
Oh, well, Michael, we've written to them on various occasions concerning various components of the plan, and we have specific approvals. As well as that, we're just following published Freedom of Information bulletins. So, for example, you know, they regularly put out bulletins like that, and the elements of the plan that we're using are either approved specifically, or they're approved generally, or they're standard business practice.
What legal documentation is required?
Well, there's quite a lot of it to make sure that we get everything spot on all the time. We're looking at setting up various agreements and trust deeds for superannuation funds, etc., and we've got specific instructions from legal advisors on this.
Who provides it?
Oh, this is provided by Mills Freehills, who are currently, I believe, the largest law firm in Australia.
What if the tax rules are changed?
Oh, that's no problem. We're in fact using a number of conservative assumptions in our figures anyway, and we can vary the whole thing around. And apart from that, the client is likely to be winning in the first year anyway, so that that's very simple.
A lot of calculations need to be done. How will this be done?
Oh, yes, you're quite right. There are a lot of calculations, but we have very considerable computer software developed now, which enables us to crunch the numbers through in very, very quick time, and we're going to be able to just keep this on monitored with computers all the time.
Now, who handles the client's money?
Oh, that's handled direct with wherever the client's going to be investing. We are, in fact, using Friends Provident Life Office for the life insurance element of this, and also for the superannuation element. We're using also a friendly society, the Independent Provident Society of Victoria, and the client just deals direct with them in that regard, so we don't actually handle any of the money.
Can the plan be varied once it's set up?
Oh yes, the plan has been designed to be changed all the time, because we realise that businesses have varying results, and the results can go up or down from year to year, and consequently the plan has been made so that that sort of adjustment can be made. As well as that, people can come and go in a business, and that's no problem either, because we've established the thing to move people in and out.
So they can bail out whenever they want to?
Oh yes, absolutely. It's been designed so that they win literally from day one.
Won't this plan increase the workload for clients and their advisors?
Well, any new thing, I suppose, does increase the workload, and if you can call doing 1 or 2 extra transactions once a year a workload, well, this would increase the workload. However, when you consider that part of our service is going to be providing, for example, to accountants all their book entries from time to time automatically from the computer, this should in fact tend to compensate for that extra little bit of work.
Well, who'll provide the ongoing service?
Oh, this is going to be a blend of ourselves, of Consulting Actuaries Financial Synergy, and also, of course, the Friends Provident Life Office will be looking after their bit, and the Independent Provident Society will be looking after their bit. And any finance that may have been arranged will be coordinated with the financier.
It seems that financial modelling is possible with this. Can you give an example?
Oh, certainly. Yes, we'll show you a diagram now. This diagram shows you just a variation on the one we showed you before, which is where we have a time-honoured financial structure. In this particular case, we see somebody who is already incorporated, and where his financial advisor has put him on a $19,500 salary, which is a very popular salary these days. So really, I suppose this just points up that what we're doing is that much more efficient than normal.
To what sort of people does FIP apply?
Oh, it applies to virtually anybody who's running an incorporated business, or perhaps ought to be incorporated. Any taxpayer who's, say, in the marginal rates of particularly 46% and upwards, or where their financial advisors are busy trying to keep them out of those rates.
You've mentioned that a variation on FIP can be used to provide supplementary executive benefits.
Yes, we've developed one which, would you believe, we're calling FLIP for short. but that stands for the Fothergill Leverage Incentive Plan, and this is an executive compensation package which in fact adopts a number of American ideas which haven't been used in Australia, but is extremely efficient. And in fact, we like to describe it as being infinitely efficient.
Leading Australian economist Dr. Neville Norman has examined FIP in some detail.
I've just finished a decade of research into tax escalation in Australia and published it recently in this book. The essential message is that although there are high hopes for the burden of taxation on high-income earners to be cut substantially through a tax reform process, but those hopes are very thin indeed. Over the next decade or more, personal tax escalation will grab like a strangler even more, I regret to say. So consideration number one is that tax effectiveness will remain a major consideration in evaluating packages like this. Second consideration is clearance. There are many packages that are seen to be tax effective, but are they cleared? Are they part of the normal commercial arrangements, like this one? The third consideration is protection. A corollary of this arrangement is that a very considerable amount of insurance equivalent protection is provided as a byproduct of this arrangement. Many other financially interesting arrangements do not provide that. Many insurance arrangements, on the other hand, which have protection, do not have the asset value at the end, and that takes us to factor number 4. The asset value for Dr. Frogmorton, as he's called, is a mere $1 million, and in 20 years' time, if you use a 6% inflation factor, that is no more than double his salary. In today's values, at about $300,000. He's going to be a modern-day pauper. Under this arrangement, 2.5 times the asset value is provided against the alternative. Finally, an important financial consideration is flexibility. We know that the tax laws, as you've seen, are not going to stay the same. Is the arrangement flexible to take account of those that we can contemplate? Is it that the changing financial circumstances of the applicant, the person that you may be advising, can be brought into account with changing cash needs in and out? This arrangement provides that. I've been through the sausage machine and looked at it carefully and thoroughly endorse it as a mechanism for providing those set of objectives.
You've seen the types of results to be obtained from FIP. Now, how do you go about obtaining more details? There is a brochure which outlines the plan. However, the best way to become familiar with it is to have actual figures run through the computer. This will mean that data forms will need to be completed, and you can obtain these from either Fothergill Proprietary Limited or Financial Synergy Proprietary Limited. If you've had initial discussions with a licensed Fothergill representative, then you may have been given data forms already. An appointment will be made for a meeting with you at which the financial modelling will take place. This is so that you can examine on screen the financial effects of following various strategies. In this way, you can be sure that any printed material resulting from this meeting will be consistent with your personal objectives. FIP could make a big difference to your future.